Morning, guys. Um, hey, want to thank you for allowing me to skip a class last week. My apologies. Um, had an obligation that I couldn't do it in the morning. In hindsight, I probably should have just recorded the class to keep things moving and uploaded it. And I know majority of you just watch it online anyway. If anybody has an idea like that, I don't know why I didn't think about that. Just shoot me an email and throw it out there. Because I could have done that. So just catching up, and we're not too far away from completing this model. So we were working on working capital, and just to kind of recap, since it's been a couple of weeks, it feels like a whole month. We had first hard coded and constructed the income statement. Then we hard code the cash flow statement and project the cash flow statement as best we can. Now we have major holes with the cash flow statement that prevent us from moving forward, namely depreciation and working capital schedules. So we built and modeled the depreciation schedule, had a little side conversation on deferred taxes, which the modeling of it didn't pertain specifically to Amazon because they do a lot of things with the deferred taxes above and beyond that goes beyond really capabilities of simple modeling, of basic modeling. So it didn't go into the model, but then we have the working capital schedule. And so we halfway completed the working capital schedule. And to move things along, I had gotten you started modeling out the current liabilities. And I said, finish off the accounts payable, accrued expenses, and unearned revenue. So go ahead and please take a look at this to match what you've done. If you have questions, let me know. But in short, accounts payable is modeled off of cost of goods sold. Accrued expenses, we mentioned, was modeled off of total operating expenses. We talked through the logic when back calculating into the formula. And unearned revenue was revenue. So we use those projections going forward, and this is what we have. So now the next task is to talk about how to link working capital back into the cash flow statement. And then guess what? We have pretty much a complete cash flow statement with the exception of the debt schedule. Now the debt schedule is something we always do last. We'll talk a little bit about why, but linking in the debt schedule now would cause too much confusion vis-a-vis the balance sheet. So really at this point, what the next step is going to be is getting into the balance sheet. So we started to lay out some balance sheet hard codes as we built out these side schedules, specifically the working capital line items and the property. So once we finish working capital, we're going to lay out the hard code for the balance sheet and then get into a big important discussion about cash flow drives balance sheet in this model, how we build the balance sheet, how to balance a balance sheet. So that's probably going to take, this class into next class, maybe even to the beginning of the third class from today. And that third class, we're going to get into the debt schedule. And that's the last schedule. Then we're done. Then we get into valuation. So we're going to talk about valuation in this course as well. All right. And then after that, I'm going to go through these courses again from the beginning for those that want to do it again with 2020. Because during these courses, Walmart has produced new financials. I didn't want to put the brakes on and go back and remodel this. Let's keep running as if they hadn't. But side note, as I mentioned a couple classes ago, the projections we made from 2020 wasn't too far off with what they ended up having. So gave good confidence that, to me at least, hopefully to you, that even this quick way of modeling gives some sort of accuracy, high level accuracy. So let's jump into the working capital. And remember, working capital is a measure of short-term liquidity, right? It is a measure of our current assets less our current liabilities. The perspective of current assets is really thinking about, how would an operator, will your short-term obligations be fulfilled by monies coming in? Will you be able to meet your short-term obligations? That's the concept. And so there's a couple of benefits of working capital. One, from an operator's perspective, if you're the head of operations for Amazon, you don't want to take a look at this to say, hey, are we going to have some sort of cash shortfall, some sort of cash emergency coming up? Or how are we doing with the customers that owe us versus the bills that we have to pay? It's a very, very important tool, working capital. So for more information on that, please refer to the last class. And so that's why we look at these balance sheet items. Balance sheet items meaning this is a balance of how much a customer owes us or how much we have to pay in relation to the operating statement items, because each of these line items are related to some sort of income. Accounts receivable, which is specifically customers that owe us money based on sales, is related to sales. Inventory, which is the cost, the raw material cost of items sold, is based on cost of goods sold. So we look at these balance sheet line items in relation to the income statement line items as a measure, as a convention for how long it might take before we receive or are owed payments on these items. And so the total working capital, i.e. current assets minus the current liabilities, tells us, do we owe? Will we be receiving money or will we have to pay money? Now you can see that Amazon has a negative total operating working capital. Their liabilities are greater than their assets. Now, what's really important for an operator is not necessarily the actual operating working capital, the liabilities outstanding versus the assets, but it's the year-to-year change. This is what we want to talk about in terms of cash flow. It's not about, is it 20 billion or 25 billion? It's about the change. Is this going up or is this going down? Because remember, balance sheet is a specific point in time. It's not a measure of how much has been collected or how much has been paid. We can imply how much has been collected or paid by looking at the difference. In other words, if we had $20 billion in inventory last year and $25 billion in inventory this year, well, at the end of the year, we've created $5 billion in inventory. We've built. That's what I care about. I care about the change. I also, looking at accounts receivable, $20 billion in receivables in 2019 versus 25 billion in 2020 means I've accumulated $5 billion more dollars in receivables. Now, the other complexity here is this doesn't necessarily mean that the customers aren't paying us, right? It could mean we have a collections problem. It could mean, wow, why is this not zero? Why didn't we collect $20 billion? What could have happened is that $20 billion were collected, but maybe we've accumulated $25 billion in new accounts. You see what I'm saying? We don't know what's really happened the whole 365 days between 2019 and 2020. And that's why we look at this in relation to the revenue being built. In other words, the shift, the increase from 20 to 25 billion can be looked at two ways. It could mean, oh, we got a collections problem. Our customers aren't paying us. Or it could mean our business is growing, right? $25 billion would actually be a good thing if our revenue was increasing in proportion to the size of the receivables. And it is, and because we're basing it on the days, looking at this balance in proportion to revenue helps us determine whether an increase or a decrease in the balance sheet line item reflects a healthy growth in our business versus a collections problem. In other words, if this 20 to 25 billion increase also reflected an increase in days, we have a collections problem. If the 20 to 25 billion increase has increased yet the days have not moved or the days have decreased, it means this balance is increasing because our sales are increasing. So think about that a little bit. And in my book, I talk about that a lot more. Really important to understand how to interpret working capital as an operator and how to look at that. But my point here is, as this relates to the cash flow statement, if this is increased from 20 to 25 billion, that means we have collected effectively $5 billion. This is going to result in a collection of $5 billion. I'm sorry. Whoa. I'm embarrassed. It's Monday morning. Other way around. If this is increased, that means we basically owe $5 billion. If this is decreased from 20 to 15, if it's gone down, if the balance has been eradicated, we've received money, right? You receive money, balance goes down, accounts receivable. Balance goes up, you effectively owed money. Okay? Sorry. Hope I didn't throw you off. Look at inventory. Easier to think about inventory. For inventory, if the balance has gone up, we have purchased more inventory. We have more products. We have more inventory. We must have paid money for that. If the inventory balance has gone up, we've spent money. If the inventory balance has gone down 20 to 15, we've sold that product. We've received money, right? So for every asset, the flow is similar. If there's an increase in asset, the cash flow goes out. If there's a decrease in asset, the cash flow comes in. Inventory is the easiest thing to think about. Inventory gets sold, you sold it, you got money, cash comes in. Inventory goes up, you've made a purchase, cash goes out. Accounts receivable, same idea, a little bit trickier to think about. I even got tongue-tied on that. Accounts receivable goes up, meaning your customers owe you more money, effectively money goes out. Accounts receivable goes down, you've collected, cash goes in. So in translating these two line items into the cash flow statement, we want to look at the change, but it's negative change because the balance sheet flow is inverted in the cash flow statement. In other words, an increase in inventory means a decrease in cash. A decrease in inventory means an increase in cash. So we're going to go line by line and go through this same thought process and translate these line items into the cash flow in order to build up this change in working capital section. So inventory, we can see inventory goes up, oops, means cash going out. So I'm going to take 2022 minus 2019, but it's going to be minus the change, okay? Minus the change of 2020. Minus 2019. Okay, sorry, just wanted to mute somebody there. So for the cash flow statement, when you look at changes in inventory, we're going to go equal to minus, open parentheses, oops, operating working capital, 2020 minus 2019, close parentheses. It's minus the change, opposite flow. Same thing with accounts receivable, equals minus 2020 minus 2019. Now you're going to find out, oops, they said they found a typo. Oh yeah, parentheses, minus, open parentheses. Thank you for catching that, Excel. Okay. And now you're going to notice for every single asset, that relationship is the same. It's always minus the change, whether it's going up, going down, every single asset. If you want to memorize it that way, it's minus the change, but it's important to see why. Okay. Now, for liabilities, let's look at this. Accounts payable. It's almost like debt. We owe money. If the accounts payable balance increases, we owe more money. Money effectively goes out. Easier to think about the other way. If accounts payable decreases, we paid our bills. If accounts payable decreases, money goes out. Okay. So the relationship is opposite of accounts receivables. Is opposite of assets. In other words, in assets, an increase in balance is money out. Here, an increase in balance is money in. Okay, we've collected. Accounts receivable, decrease in balance is money in. Okay, accounts payable, decrease in balance, money out. We owe money. Think about debt, right? Debt goes up, you've borrowed money. You get money in. Debt goes down, you spent money. Money goes out. Accounts payable goes down, you've paid your bills. Money goes out. Accounts payable goes up, we effectively borrowed money. Money comes in. So when looking at changes in accounts payable and looking at here that balance is increased, we've effectively received cash. Money's coming in. So equal to 2020 minus 2019. It's not negative the change. It is directly the change. More logical. Balance up, money in. Balance down, money out. And for every liability, it will be this way. It'll be plus the change, no matter what. If you want to just memorize it that way, assets are negative the change. Liability is plus the change. And there you have it. So now our changes in working capital means we've effectively collected $8 billion in cash. Okay. We're going to apply this all the way through. Copy to the right. Okay, take this highlight out. Okay. Now we have this match here. I want to explain this match. Okay. So this match basically says, well, let me look at the total change in operating working capital. Okay. Copy this to the right. Let me look at the total change in operating working capital. This match is a sanity check for us. This match basically says, okay, we have calculated working capital two different ways here. We have in the cash flow statement taken each individual line item and calculated its independent cash flows and added it up. Here, we've done the same formula in a different way. Here, we took the total balance in 2019, the total balance in 2020, and subtracted the balances. Think about it that way. In my book, I give a better illustration. It leads us to the same number, 8404.9, by subtracting the balance, or by adding the individual flows, 8404.9. Those numbers should match. Okay. If they don't, this will say no. Now, the reason why this didn't say no is because what I need to do here is, so I need to do negative the change, minus this year minus last year, right? Because working capital is effectively a net asset. So if this is going down, it's cash coming in. Negative the change. The numbers tie. This helps us make sure that we have linked each line item in the working capital into the cash flow statement in the right way. And we've included every line item, because the most common mistakes analysts make when linking working capital to the cash flow statement is either they've mismatched a line item, meaning there's an extra line item in the working capital that you didn't put in the cash flow statement, or maybe there's one item less, or you've linked it in the wrong way. And the best way to prove that you haven't done that is by, number one, making sure your formula are consistent. So every asset is minus the change, every liability is plus the change, and double checking to make sure you've included every line item. 1, 2 assets, 3 liabilities, 2 assets, 3 liabilities, and making sure that you have this formula that matches. Okay. So now that we've linked this cash flow statement together, okay, we can go ahead and look at the balance sheet. Let's talk about the balance sheet. Okay. Oops. Did I skip it? I skipped it. Nope, I didn't get to it yet. Here we go. Okay. Now, the balance sheet is a summary of a company's assets, a company's liabilities, and the owner equity at a given period of time. Okay, so this is different than the income statement and the cash flow statement in that it's more, what do we have now? What do we own? An asset is really, what do we own right now? How much, what's the value of our property right now, today? As opposed to an income statement, which is how much has been accumulated over a period. How much sales do we generate over a year? Right? That concept of how much sales do we have right now doesn't really translate, doesn't really make sense. You could say how much money we have in the bank account now. That's an asset. How much sales did we generate? That's more a period of time. You have to think about that over a period of time. But a balance sheet is more, what do we have now? What do we own? Assets. What do we owe? Liabilities. How many bills do we have to pay? Accrued expenses. How many customers? Sorry, how much debt do we owe today? What's our balance and liabilities? And stockholders' equity. How much equity is out there? How many shares have investors invested in? It's a balance. It's a statement of what we have and what's due. And there's this balance sheet formula that everyone should know about that keeps a balance sheet in balance, that the value of your assets minus the value of your liabilities should be equal to the shareholders' equity. It should match. It should always tie. It should. It has to. If it doesn't, you have a problem. So the tricky part in modeling is we're going to take each asset and project it out going forward, line by line. We're going to take each liability and project it out forward, line by line. We're going to take each piece of shareholder equity and project it out forward, line by line. And in doing so, this formula should still hold. And there's a way of thinking about how everything ties together. Income statement into the cash statement, into the balance sheet, such that even though we're projecting each line item within these sections independently, this formula is still holding, keeping the whole model in balance. Okay. So as we spoke about, the formal definition of an asset is a resource that has some economic value. You have to apply a value to it. It's a car, you got to apply a value to it. It's owned by the company. And the idea is it needs to provide some future benefit. In theory, if it doesn't have any future benefit, it has no value. It's an economic resource. And assets come in two major categories, current and non-current. Current assets, we spoke about working capital, are assets that are expected to be liquidated within 30, 60, 90 days. Easiest example is accounts receivable. If the customer has ordered a product, we've given that customer the product, we've sent them the bill, they owe us money, they should pay us within 30, 60, or 90 days. Otherwise, they're defaulting. It's a current asset. Inventory, products to be sold. We talked about this. Cash is, by definition, a current asset because it's already been liquidated. It's cash. Okay, current assets. Long-term assets, examples of long-term assets, PP&D, property, plant, and equipment. Right? And we'll talk about how that's modeled. This is an example of how PP&E is modeled. We'll talk about this when we go into the model. Goodwill. We talk about really more in mergers and acquisitions. To refer to my book on mergers and acquisitions. But in short, when you value a company has a specific value, say $1 billion, let's say. If you were to buy a company and you were to pay more for the company than what it's stated on its books as being worth, which is almost always the case. You got to pay a premium to convince the seller to sell their company. You usually always have to pay a premium. Sometimes you don't. Sometimes you pay a discount, but generally, if you pay that premium, how do you account for that premium? Now, if the balance sheet says, hey, I'm worth $1 billion, you give me 1.5, what happens to that 0.5? It's a gap. It's going to be an accounting gap. That gap, generally, I'm being very, very basic. It's a little bit more detailed to it than this, but in general, that's goodwill. It's the premium paid. So we don't get into that so much here. Okay, liabilities. Liabilities are debts and obligations. What a company owes. Okay, now there are, like assets, there are current and non-current portions of it. A current liability is an obligation that comes due within a year. We have accounts, let's say accrued expense, meaning basically we have a bill, I don't know, oil, fuel, for an example. We have a bill sitting on our desk. We got to pay it in 30 days. Due in 30 days. It's a current liability. Short-term debt is a current liability. Debt that we have to pay within 30, 60, or 90 days. Non-current liabilities or long-term liabilities are debts or obligations that are due, outside of 30, 60, or 90 days, a long-term. Debt, deferred taxes is a long-term liability. Any other outstanding loans. And then shareholders' equity. Shareholders' equity is the value of equity that our owners, public shareholders, preferred shareholders, investors have paid. It's also known as the assets minus the liabilities. This is where that whole that whole formula needs to stay in balance, where we're going to project out our shareholders' equity, yet it still must match such that our assets minus our liabilities tie. So some main components of shareholders' equity: common stock, preferred stock, straight up the investors. The retained earnings. Retained earnings is a concept I hope most of you have heard of. If not, it's the net income that's not been paid out. So in other words, you remember the bottom of your income statement. The bottom of your income statement, you have net income, and underneath you have dividends. Dividends get paid out to your shareholders. Anything left over, net income minus your dividends, go into the balance sheet as retained earnings. Any net income or earnings by the business that have not been distributed to shareholders help build equity in the business. So the equity balance increases by the retained earnings. The income coming into the business, less dividends. Okay. And then there's this concept called treasury stock. This is stock that's been bought back by the company. A lot of times, and we talk about this in the book. I wonder if we'll get to it, let's say, in these classes. But one strategy for a company to increase value, increase stock value, is to buy back stock. Right? It's a little concept called anti-dilution. Let's think about the opposite thing. If you were to issue shares in the market, there are more shares in the market than before. Each individual share becomes diluted effectively. There's this concept of dilution. The implication is the value of each share might go down. While the opposite would theoretically happen if you were to buy back shares. If you were to buy back shares, there's less shares in the market, then each individual share's value should increase. Anti-dilution. So a strategy a lot of companies could potentially use to increase value in their stock, and let me tell you, Amazon doesn't have that problem, is to buy back shares. The repurchase of shares is called treasury stock, stock bought back. It's a negative to your shareholders' equity. It reduces, you're buying back. It's a purchase. Right? Equity acts like liabilities, where a positive, an increase in the asset is cash coming in. Right? Stock. You are to raise stock in the market, your value of stock increases. Investors buy that stock, they give you money, you receive money. Stock, so your stock increases, money comes in. You were to buy back stock, value stock decreases, you spent money. Okay. Okay. So let's open up the balance sheet. Now, like the cash flow statement, for the most part, we're going to model out the company's balance sheet line by line. Okay. Oops, let's go to Amazon here. So let's open up the Amazon 10K and let's look at the Amazon balance sheet. And we're going to model this out line by line. Let me try to cheat here. I'm going to click table of contents. You're going to work for me. Let's see. And we're going to go into selected consolidated financial data. Okay. That wasn't running out of time. Okay. Let's talk about this quickly. And that way you can at least get started, and then perfect. Tomorrow, next week, we're absolutely going to get into modeling the balance sheet. You want to go in line by line. What I'm going to do is I'm going to tell you what to do. Here it is. Okay. You're going to literally hard code in line by line. Let's just go through it. I'm not going to type it in, and then I'll type it in and I'll upload the model. Okay. I mean, I'm not going to type it in with you. I'm going to type it in afterwards. Not waste time typing. Cash. Okay. We're going to hard code in here. Notice the balance sheet only has 2 years. Common the case. Balance sheet shows 2 years, even though they have income statement and cash statement of 3 years, the balance sheet they've shown 2. Cash, we're going to hard code in 18 and 19 respectively. Marketable securities. Okay, marketable securities. We're just going to lay in. Oops. Line by line marketable securities. So we're going to create our own line item for marketable securities. Okay, we're going to append this marketable. Oops. Marketable securities are investments in assets. Okay. Then they have, what's going on here? Then they have inventories and accounts receivables. Okay, we have that inventory, accounts receivable. These line items don't exist for them. That's just part of the template. So that's it. We will total up total current assets. But then they have property, plant, and equipment. We've already hard coded the 72 because we needed that for depreciation. Let's hard code property, plant, and equipment. They have some goodwill and other assets. Goodwill and other assets. These other line items I had hard coded in because these are common line items. There's 0 for Amazon. Then we'll have total assets. Real easy. Okay. Liabilities. So liabilities, accounts payable, accrued expenses, unearned revenue. We had those, we had to lay those out already for our working capital. Okay. Total current liabilities. That's it. They don't have short-term debt, unbelievably. Most companies always have short-term debt. I was very perplexed by that, and believe it or not, once we look at 2020 financials next year, short-term debt's going to pop up. Anyway, that'll be 0. Total current liabilities. Now, long-term lease liabilities. So we're going to have to create a line item for long-term lease liabilities. Okay. We want to match what they have. Long-term lease liabilities. Then they have long-term debt and other long-term liabilities down here. So they're going to have 0 deferred taxes and 0 pension. Okay. I have a feeling. Now we know they have deferred taxes because we saw that table. They've probably lumped it into other. Fine. It's okay. Here comes shareholders' equity. Preferred stock, none. We have a preferred stock line item. We'll make it 0. Okay. Common stock and additional paid-in capital. Now, look what I have here. This is one of the few things that we often consolidate in a balance sheet. Common stock plus additional paid-in capital. We often combine that. Why? I got a little bit of time to briefly explain. So, and I talk about this a lot more in the book. Common stock, generally listed here, is the par value of shares outstanding. If anyone doesn't know what par value is, I'm going to explain quickly. When you issue stock, okay, now Amazon stock is not trading at the market at $5 a share or millions, billions at this point, millions, $5 million. It's not. I mean, $1 million per share. Sorry. Their total value of stock outstanding in the market is not $5 million. No way. They're worth like $500 billion right now. It's crazy. But when you first issue shares out in the market, okay, and not 500 billion, sorry, 50 billion, 26 billion. When you first issue shares, this is a legal accounting rule. You have to list a bottom line value of what your stock could be worth. It's a penny a share, $1 a share, something simple and round, $10 a share. That is the par value. You have to put something down. So when you issue stock, you have to first list some sort of base par value. That par value goes here. Once the stock gets sold in the primary market, that stock gets purchased for some value above the par value, more than the par value. That difference is called additional paid-in capital. For us, for modeling, we don't need to separate. We just want the total value of that one share or of all those shares. And it makes it easier for modeling. So that way, when we model stock issuances, we don't have to separate out par value versus additional paid-in capital. It's going to be too complicated. When we issue stock, we have one stock issuance line, and it's going to link into one balance sheet line. So we combine together always the value of common stock plus the additional paid-in capital. So the 26 billion adds to the 5. Okay, so we have common stock plus additional paid-in capital is going to be equal to 5 plus 26,791. Okay, I'm gonna have this hard coded and then I'll send this over to you. Okay, here's treasury stock less repurchased. They have accumulated other comprehensive income and retained earnings. Okay. Then everything gets totaled as stockholders' equity, and then I'll run through this part very quickly, but this is what we're going to start talking about next week, and we'll talk about modeling. Then we add up the liabilities and the shareholders' equity, and this should balance. Balancing meaning the liabilities plus shareholders' equity should equal to the assets. Same idea as assets minus liabilities equals shareholders' equity. Simple algebra. Other way of looking at it is assets equals the sum of the liabilities plus the shareholders' equity. If this doesn't balance, if this says no, you've hard-coded something in wrong. So give it a shot. I want to quickly just talk about accumulated other comprehensive income real quick. Then we'll end this and we'll dig into this. We'll really dig into this when we have to model it out. Accumulated other comprehensive income is, and you might have seen underneath an income statement, a small statement that says statement of other comprehensive income. Here it is, statements of comprehensive income. There are some things that might increase or decrease your net income. That's not, I don't want to say admissible, but it's not commonly or appropriately stated on your income statement according to the general accepted accounting principle rules. Things like gains and losses based on foreign currency transactions. Things like increases and decreases based on write-offs, stock write-offs. We'll talk about more things like that. Although this could impact your net income, these line items are not, according to generally accepted accounting principles, are not to be put on the actual income statement. So it goes into this small side statement called consolidated statement of comprehensive income. Line items like this here, foreign currency transaction adjustments, that might flow into the cash flow statement, will also flow into not retained earnings, because I said retained earnings is net income. Well, line items related to comprehensive income will flow into your other accumulated comprehensive income or loss. Okay. I know. As I'm talking this out, it sounds like a lot and it's confusing. So I promise you, when we model it out in the cap from next week and link this from the income statement to the cash statement to the balance sheet, it'll become more clear. Okay, I have less than a minute. Guys, this has been great. I'm going to upload this. I'm going to upload the video. Look forward to seeing you next Monday. We'll build and model the balance sheet. I'm excited. Thank you.